Thanks for staying here on the JoyNews channel on Multi-TV. I'm Bernice Abubedu Lansa. We now bring you our next coverage. We are not doing regular programming at this time. We are taking you to the Where to Invest in Africa report breakfast meeting. Lead economist at the Randbank of RMG Group, Celeste Fauconnier, is addressing investors on Africa's economic outlook.
Finally, I'm delighted to see that we have so many customers of our bank here, as well as from other banks as well, and hopefully next year I'll be able to welcome you as customers of First National. So once again, honoured guests, ladies and gentlemen, welcome to First National Bank's Economic and Business Breakfast Forum for 2019. Thank you.
Can we do a better round of applause for Mr. Hudson? Went straight to the point, recounting recent history and the hopes of the future, and setting the tone properly for a very interesting conversation. Ahead of the conversation, we'll have a presentation by the co-authors of the report. Celeste Fauconnier is making a return, and it's a pleasure to have you back. And as we progress, she didn't come alone. She came with a co-author, Neville Mandimika. Ladies and gentlemen, let's welcome them as they give us the presentation.
Good morning, ladies and gentlemen. I firstly want to thank First National Bank of Ghana for having me every year. It's always nice to come to one of my favorite countries in Africa. I'm not just saying that because I'm here. And then I brought Neville to make us look even better, the handsome man on my right. He's only got 2 slides to do. I'm doing the rest. But I think he's doing one of the more difficult slides of the capital markets in Ghana. But without further ado, I would like to go straight into the presentation because, obviously, time permitting, I want to highlight what the key findings is of our flagship document called Where to Invest in Africa. It's now in its 8th edition, and we're almost heading to the 10-year anniversary. And then also dig a little bit deeper into the theme that we have in the document this year, which I'll discuss now. And then, of course, just end off with where we are seeing Africa, or Ghana rather, representing itself in Africa and how it's been doing over the past few years, but mostly with the focus on how we are going to do in the next 5 years. Going straight into the document, which is available on our website, we look at specifically the economic side of African economies, and we look at the business environment. Now, specifically looking at the overview of the document, we look at who's the best ranked economies in Africa according to their attractiveness. So that's called according to a certain methodology that we use, and highlighting specifically economic outlook, so the growth over the next few years, GDP growth, also the market size of each of these economies, where we know that Egypt, Nigeria, South Africa are your largest markets. And then I think the most important component that we look at is your operating environment. So how easy is it to do business in these economies? For that component, we use different surveys across the world, specifically looking at the World Bank's Doing Business report. We also look at the World Economic Forum's competitiveness report, giving us an indication of where we are seeing improvements in the regulatory environment in most of the African countries. Together, we give 50% weighting to your economic activity scoring and then 50% weighting to your operating environment scoring. It might sound like quite a simple methodology. The reason why we keep it this high level is because there are so many different sectors that are sitting in this room at the moment, looking at different risk appetite, looking at different avenues of investing into our African markets. Within the document, however, we do give different weightings to all of these indicators. So you can literally play around a little bit to see where you benefit the most, whether it's from a risk-off perspective, a risk-on perspective, or if you want to see where the biggest growing markets are going to be one day. Essentially, the rankings that I'm going to show you now is this 50% economic activity scoring and the 50% of your operating environment. So who are the winners in this year's publication? Egypt, for the second time in the 8 years that we've been writing this document, has made the #1 spot. It's overtaken South Africa as the most attractive investment environment, much to the dismay of us South Africans and our media. But there's reason for this. If we go back and look at the methodology that I've just explained, Egypt's growth rates are much higher at the moment and forecasted for the next few years, where South Africa is only going to grow about 1 to 2% over the next 3 years. Egypt is growing by 4 to 5%. And of course, Egypt is now the largest market in Africa, above Nigeria, if we look at it in purchasing power terms. South Africa is still one of the best business environments. So if we had to look at it from a risk component, South Africa will still be number one. We are still the largest markets, capital market and portfolio or equity markets, and we're the most liquid. So there's reason why we are still number two as the most attractive investment destination. I don't want to go through all of these countries because that can take me all 30 minutes that I have to speak. But I just want to highlight that the countries that are often, well, almost all the time in the top 10 are your East African stalwarts like Kenya, Tanzania, and Ethiopia. And then from a West Africa perspective, we see Ghana and Nigeria, and also Cote d'Ivoire coming into the top 10. And then from a North African perspective, we always see Egypt and Morocco in your top 5. Highlighting Ghana, if you did read the previous year's document, unfortunately Ghana has slipped down the rankings. Where Ghana was number 5 in last year's document, it is now number 9. But I think we would rather leave that discussion for when we have the panel and where we will answer those questions. But in short, it is the fiscal indiscipline that we've seen in Ghana over the past few years that is now showing a delayed reflection in some of the surveys. So we can see there's still that investor concern of what is going to happen from a fiscal health perspective in Ghana over the next few years. That's the main reason. And we can also discuss all the other countries after the breakfast presentation. The main focus is who's the next top 10. So we can see other countries that you might have asked, where's Mauritius? Where's the Botswana, for instance? Very easy business environments. Why aren't they in the top 10? But we always say they're still very small markets, and these markets only have about 4 million people altogether in Mauritius, in Botswana, in Namibia. Also, these markets are only growing by about 2 to 3% over the next few years, so very similar to the rest of Southern Africa, we are feeling the pain. The consumer is not doing very well. The extractive industries are also not doing that well because of slower than expected commodity prices. Then from a Southern African perspective, we also see one of our countries, Zambia, in the form. Zambia is also a country that is currently battling with also its own fiscal indiscipline. And then another country that has come back into the top 20, a very interesting one, is Angola. Angola, the reason why it's moved back into the top 20 is higher oil prices, and we've seen a significant change in the political stability of the country over the past 2 years. So, ladies and gentlemen, that is the crux of the Where to Invest in Africa document. So you can see now who the top 20 most attractive destinations are in Africa. And of course, we can also use the panel discussion to argue some of these countries that are in the top 20. A very good example, Tanzania being in the top 10 is being questioned quite often by some of our clients because it's a very difficult business environment, and we see that the regulatory environment is being clamped down on. If we look at specifically what is going to happen in Africa from a growth perspective, this is the regional GDP growth profile. Now, we can see that your countries in your emerging and developing Asia are the ones that is going to drive this growth. Yes, we are indeed seeing a country like China experiencing a slight soft landing, but it is still an economy that invests heavily into Africa, and we do not expect that to change anytime soon. But the question is, over the long term, where is Africa sitting? So we're still above most other regions in the world, and we're above world growth. But I do not think that we are going to experience that 6 to 7% growth rates that we saw a few years back in the future. I think it will be around a 3 to 4%. The biggest reason for this is that we are still battling with rising debt levels. Us in the country of Ghana, we understand that experience, and we also see weak credit growth, where it used to be quite strong over the past few years. We are seeing that developing again, but it's going to be at too slow a pace. But the prospects are still strong. So we still have resources, even though it could be the crux of African economies, we still have it. And I believe that in the next few years, agriculture is going to be one of the biggest drivers of your resources sectors in Africa. We still have strong demographics. We still need countries to take advantage of this. We are seeing improved business environments. It's only in certain pockets across the continent, and the document does highlight which countries those are. And of course, we are seeing the potential of more revenue collection. Even though this is a big risk, it should be both in the risk and the prospect section. But revenue collection is still so low in Africa. Just a few simple changes that governments make can improve this revenue collection. And one of the areas that is an easy way to do this is bringing your informal sector into the formal sector. Governments need to get strong initiatives for these informal and entrepreneurs to come and enter the formal sector, whether it's lower taxes or just ease of getting their goods from point A to point B. Many aspects governments can tackle. Then specifically looking at the most problematic factors of doing business in Africa. It is liquidity, so access to financing, and it's infrastructure. And this leads me exactly to the theme that we are focusing on this year in this document, is infrastructure. The 2018 document looked at access to financing. So if you want to go back to those documents, we focus on the currency risk in most of these economies, where the liquidity is coming from, what are the largest export revenue earners for each country in Africa. This year we focus on infrastructure. We have seen a significant deficit over the past few years, and that deficit is just growing. So briefly, and I do understand that the text on this slide might be quite small, and for those in the back not seeing it, but it's just to highlight that the infrastructure needs in Africa has now changed from that $90 billion deficit annually to about $130 to $170 billion now annually. That's the changes we've seen in the latest Africa Development Bank report. And it's nothing new. We all know the problems. It's electricity, water, technology, and the actual hard infrastructure of road networks, railway, ports. And this year's document focuses exactly on that. Where does the deficit lie in each of these countries? And with that deficit, we highlight that this is the major opportunity for you as investors to go into these markets. If we look specifically at which countries have the best quality infrastructure, and again, I will highlight, because the text is so small, this is an index by the African Development Bank looking at all types of quality of all infrastructure in Africa. It's roads, railway. It also looks at your water and sanitation. It also looks at electricity. And then lastly, at your health and your education. So your more soft infrastructure. And the winners here are countries like the island economies, Seychelles. Seychelles has the best quality infrastructure in Africa. And the reason for this, and that most island economies have good infrastructure, is because they want to attract tourists. They want to get those tourists safely from point A to point B. And of course, they've got some of the best ICT, or information and communication technology, in Africa. It's because they want their tourists to be able to connect to the outside world in an easy manner. We also see that countries in North Africa and Southern Africa are also at the top of the infrastructure rankings. It is because we are, South Africa specifically, one of your more developed economies. Egypt also. Egypt, in fact, has been ranked better infrastructure than South Africa. And a very good example here of a country that can ruin its infrastructure is Libya. This is the 2018 index for Libya. So we can see Libya is actually third best infrastructure quality in Africa. But now what we've seen with the political turmoil, the civil war, it's actually been breaking down that infrastructure. So in the next year's survey, Libya will definitely not be in the top 10. Ladies and gentlemen, Ghana is still there. They're in the top 15 of best infrastructure quality in Africa, but there's still a lot to do in the country. Most of West Africa is investing below 3% of overall government GDP into infrastructure. And we have learned that you need about 6% to 7% investment of your GDP into infrastructure to at least have growth rates above 3% annually in Africa. So there's a significant need still in the market. Before I end off with looking at the Where to Invest in Africa document and go more into what's happening in the Ghanaian economy, we look at financing of infrastructure. Now, this is the opportunity and the deficit that I've highlighted earlier. At the moment, it is the governments that are investing the most into infrastructure development in Africa. But this is the problem. As I've mentioned earlier, most of these governments only invest 3% of overall GDP into this development. So it's something that needs to change drastically. In fact, you can see by the following slide that the Africa's infrastructure funding sectoral split is quite broad. Compare left-hand side to the right-hand side. On the left, that is your government investment into infrastructure. We can see that goes predominantly into your harder infrastructure, like your electricity, and then your your transport and your energy and utilities, which is understandable. The government needs to win votes, so you still need to invest in aspects that will get the economy going and that also can get your people from point A to point B. If we look at the right-hand side, private funding, which is only 10% of overall funding into African infrastructure, these companies focus mostly on construction. And why is the reason for this? Is because construction is your easier and short-term investment or infrastructure investment projects than what we see in your electricity or in your roads and railway networks. It's because the risk in Africa is still very high. So we see that infrastructure investors, from a private perspective, are still wary to invest in your long-term projects. We are hoping that this movement will change over the next few years, but that is where the regulators need to step in and start changing their business environment to get this funding into the market. And it's at a critical time. As I've mentioned earlier, your debt levels are increasing significantly in Africa. So we are needing that private sector investment to come in. So things need to change very quickly before we are in highly debt-distressed economies across most of the African continent. Just to also highlight your public and private investment, this is just a graph illustrating the number of projects happening in most of our countries in Africa. Again, the text is quite small, but I'll just highlight that Nigeria, Ethiopia, and Egypt are the largest recipients or the largest projects happening at the moment in those economies. Where you can see the blue bar is your public investment projects, and your private is the yellow bar. Countries like South Africa is also still seeing investment, but we're starting to drop down. It's because of the risk that is perceived is getting higher in Africa, or South Africa rather. And of course, us having the potential of being downgraded again by one of the ratings agencies. But essentially, this is again highlighting the problem we have. It's the public sector that is investing. And of course, we have to highlight the biggest problem across Africa at the moment, well, not at the moment, it's been for many years, is corruption. And that is affecting this investment going into these infrastructure projects. I just also want to lastly highlight, from an investment attractiveness perspective, what we've done with this graph is just highlight the previous graph that I showed you, number of projects happening in Africa at the moment from an infrastructure perspective, and we've plotted it on your y-axis against the RMB's investment attractiveness scoring, those top 20 that I've showed you earlier. And we can see there's a very strong correlation between those countries that have very active and a large amount of investment into infrastructure projects, so very strongly correlated, as I've highlighted, to where your most attractive investment destinations are lying. So I think the opportunities there for countries to at least bring them back into the top 10 or move up into your top 5 most attractive investment destinations is infrastructure development. So, ladies and gentlemen, that is Where to Invest in Africa, the publication in a nutshell. There's still many slides that I can show you and that we will have available for you after the breakfast presentation. But of course, we are also here to give you our views of what's happening in the Ghana economy. Specifically, I will highlight all your general macroeconomic indicators. I'll briefly focus on what we expect to happen with your growth rates, what we expect to happen with inflation and your interest rates. Naturally, we have to discuss the currency, but I think I came at a very good time when we've seen the currency come back nicely and strongly. And then, of course, Neville will end off with just highlighting what's happening in your capital markets, so your local and your hard currency bond market. So starting off with your normalizing GDP growth rate. Now, when we are talking about normalizing, what we are saying is that growth is just going to go from that high peak of 8.5% that we saw recently, normalizing back to around a 5% growth rate. So it's nothing to be concerned about. The reason why it is normalizing is that oil production that is normalizing. So we saw a very nice increase in your oil production, more than 50% increase in 2018, and expected about 40%, 30 to 40% increase in 2019. So that's boosted your growth rates quite significantly. As I mentioned, that will ease off to a very strong 5% growth rate. We can actually see that it is tracking above the sub-Saharan average of 4% growth. So still strong growth, but unfortunately, this growth is still driven by your extractive industry. So gold and oil will now be the largest, or has been the largest providers of GDP growth. And unfortunately, we are seeing that your non-oil or your non-extractive industries are still battling ever so slightly to boost that overall GDP growth rate. And the reason for this is, unfortunately, with the under-execution of CapEx or capital expenditure, basically due to the fact that the economy or that the government had to start consolidating fiscally, we have seen that affecting capital expenditure into the market, and that's been affecting the growth rates quite significantly. There's not enough money to be able to spend as much as the government would want to be able to boost the growth rates even more. There's also been poor asset quality in the banking sector, but we are seeing that changing now, especially after the recapitalization that Richard has been referring to. So we are expecting that your loan growth will expand again over the next few years, and private sector credit extension will also now be boosted. So we feel that that's going to play a big part in that 5% growth rate that we are expecting over the next few years. But it is these two sectors, gold and oil, that is still going to be your key drivers, and it's still doing relatively well. Specifically looking at your gold production on the left-hand side, we are starting to see that it's tracking up, and the reason for this is not only that we expect gold prices to increase ever so slightly in 2019, so that will boost your export revenues, but we are starting to see that your big mining companies, AngloGold Ashanti, Gold Fields for instance, have decided that they are going to increase the lifespan of their gold production, so that means they're going to invest more into their mining. That means they are investing more into the economy, so that's a positive. On the right-hand side, even though we are seeing crude oil production that will eventually start normalizing, it's just a normal thing to happen. We've seen it in most countries that produce oil. But unfortunately, that crude production is still very minimal compared to what we see other countries are producing, like your Angolas and Nigerias of Africa. But it will contribute to that foreign exchange earnings that we do need over the next few years to keep the currency at a relatively stable level. So at the moment, that's I won't say the saving grace for Ghana, but it is helping definitely keep that GDP growth rate propped up. Then I just want to highlight what our view is on inflation and rates, and with our esteemed panel members, we can also discuss that in further detail. Indeed, we are expecting February and March numbers. Well, we've seen February numbers coming in slightly higher than what we saw in January. But that is on the back of that weakness that we saw in the cedi, which is most likely going to filter through further into March. But thereafter, we will see the inflation rate stabilize again. With that, it's possible that it can head close to that 10%, but we do not expect it to go over the double digits. So this is still a positive. It means that we are still trending very close to your target band. That's that green section that you can see on the graph on the right-hand side. With that, we expect the policy rate to remain unchanged at 16%, something we can debate of whether it should have been dropped to 16%, and it's part of the reason why it's probably exacerbated the currency instability that we have seen over the past few weeks. But essentially, we cannot see inflation coming down significantly for the central bank to cut rates even further. And of course, we know that the central bank would also want to maintain an attractive rates for investors to come into the financial markets. So we believe that there won't be any change to this policy rate. There are even calls for them to reverse the 100% or the 100 basis points cut that we saw recently. I do think that will just send very confusing messages to the market, and it will just make it unstable and making concerns for investors of what is really going to happen in future from a monetary policy perspective. So for now, that's our view, 16% for probably most of the year. And then, of course, we feel that the FX supply and the stable utility prices will also support stable inflation over the next few months. So there's no big red flags that is flying in front of us from an inflation perspective. I think what we should be concerned about is your fiscal discipline over the next few years. This is probably Ghana's biggest test that we have seen in a very long time. And of course, we know it's because the IMF has now exited the market or is almost exiting the market. They did have a positive report on the latest review, which is great for sentiment. But of course, sentiment also needs to be backed by a track record. So the budget deficit, what we're expecting for 2019 is 4.5%. So it's very close to the 4.3% deficit that the government is expecting over the next few years. The reason for the increase is the government would want to invest more into infrastructure projects, which is a positive. My biggest problem is, will the revenue collection be able to manage that expectation? And we have seen that revenue collection came or underperformed in the 2018 budget. This is where we know that the government needs to work hard on that tax collection, especially. That is where we also saw a bit of a drawback. So if we invest into changes like that, and if we also see that the government maintains that fiscal discipline of below 5% deficit over the next few years, I think that we will continue seeing investors coming into the market. They just want that certainty. So the positive also of the latest budget, the outdated earmarked funds as well as your unsustainable tax exemptions will be reviewed. I think that is the major positive. We just need to see that now happening. I want to highlight, though, the biggest concerns we have over the next few years. The fiscal adjustments definitely has been substantial, but it is definitely also reflecting, as I've mentioned earlier, in the capital expenditure of the government into the market. So we are going to see some missing targets because we are going to see some missing revenue targets as well. There's also been sizable fiscal slippages, as we all know, during election years. Some of our clients, specifically from London, are asking us what is really going to change in the next election to not have them overspend again. A very good question, which we cannot answer. The Ghanaian track record is of overspending during election time. And then, of course, you've got the extra concern of the extended credit facility of the IMF now coming to an end. So public debt is set to fall because of that fiscal consolidation. But unfortunately, we do not believe that it will go under 50% for at least the next 5 years. And 50% is quite a challenging number for any African country to be able to maintain. And I know Neville will also touch on how we are going to, how that's going to reflect in the debt market. The positive thing about the new fiscal rules is that we are seeing the government making the effort, especially when we see them putting that cap on a 5% deficit. But unfortunately, as I've mentioned, track record is very key for investors to come into African markets. So these new rules, we do not have a track record. We do not know if it is going to work. Even though it's positive, it's something that I do believe investors will look at as a wait-and-see process. And we will actually see that filtering into the market, where we would have seen strong investment coming into the market once the EM risk-on environment is back. But unfortunately, with that track record, we're going to see investors put a hold on significant investment into the market. I will end off, before I hand over to Neville, on the volatile cedi. You can see I've put that last so I can quickly run through, because trying to forecast this currency at the moment is very difficult. Traditionally, the cedi is a depreciatory currency because the imports exceed your exports, so it's just a natural progression. And we see that in most of the African countries. And also with it being a managed float, we do not see this depreciation going out of hand. But obviously in recent weeks, we saw significant volatility in the cedi. There were different reasons, and we can go through them very briefly because I know you know your markets also very well, but it was seasonal. So we always see in January and February a significant weakness in the currency, mainly because importers are demanding goods or demanding dollars to pay off goods. And then, of course, we have also seen EM suffering a capital flight. So Ghana being one of your more of your EM, being one of the countries rather in West Africa, after Nigeria being a recipient of portfolio inflows, we have seen an outflow over the past few months, which has heightened that concern about investing into the continent. And then we've got, naturally, the rate cut that we've seen recently, and that has exacerbated the situation from the steady volatility. So yes, we are starting to see some regulatory changes by the central bank, and they are just saying that it is not to curb what happened now, it is to potentially curb massive liquidity swings in the future. But it's something we're watching this space, we just need to get more clarification of some of the changes. So we are quite positive, and we felt that the currency will eventually come back. It does usually in a traditional way come back after a volatile January and February, but we also knew that there will most likely be a Eurobond issuance, that they will tap into the cocoa bod, that the IMF funding is going to come through. And then, of course, we saw a significant reversal in some of the losses because of that financial arrangement the central bank made to start replenishing the reserves. So we can see arguments for steady stability, and we're keeping our year-end forecast at 520. We'll see how it goes. But the financing arrangement by the Bank of Ghana, with that, the IMF disbursement that just came through, or will be coming through after the review, of almost 200 million. You've now got a Eurobond of $3 billion US. There's still a 300 million drawdown of the COCOBOT syndicated loan coming through. Then, of course, we are starting to see that your oil exports are increasing again, and it's expected to increase to about 180,000 barrels per day. Then we know that China's Sino Hydro drawdown could also be a debatable drawdown, but that we can leave for later discussion. And then, of course, we are going to see a restrictive budget and a positive trade balance. So all of these reasons are backing the reason why we think the currency is stable to come back and will probably end the year at 520. I'm also handing over now to Neville so that he can maybe just conclude the reason why we're expecting steady stability and how the financial markets and specifically the capital markets have been doing of late.
So I think Celeste made a mistake. We won't be concluding, because for the next 3 hours, I'm going to be walking through the minutiae of the fixed income. No, I'm joking. We as economists are paid to talk, so that's part of what I'm getting paid for, so I have to talk a lot. No, but I'm joking. But I think the important thing over the last, I would say, a few weeks has been the relationship between the domestic fixed income market and what has been happening in the SEDI. And I think there's some insights in terms of the interplay between these two asset classes that we can possibly dive into. So what I've plotted for you on the top chart there is over the next couple of months, what portion of the interest that is due on the domestic bond markets, that is due to the offshore market, and what is due to the domestic bond market. Simply because of the reason that the interplay between the offshore market and the domestic is quite important in terms of the pressure that we see on the FX market. So if you typically have a large base of offshore investors that no longer feel that they are, it's a worthy investment to be invested in the domestic market, then that's going to put pressure on the FX market. And we've seen that over the last few weeks or so, where there were some issues around global emerging markets and whether that was a good play for investors, with dollar funding, who are typically invested in the Ghanaian market, whether it's a good investment or not. So we saw some pressure in terms of coupon payments that were possibly exiting, and we saw some of that feeding into the FX volatility that Celeste just explained. So that is quite important for us as we look at Ghana in the context of what is happening in the global EM space. Right now, we've got a fairly what can I say, accommodative EM environment where people are starting to look for riskier assets, and that is good for us sitting here, simply because there is, appetite for offshore investors to be looking at Ghanaian assets again. But the problem with that is that sentiment tends to be extremely fickle. So in 1 week, you've got a risk-on environment. In the other week, you've got everyone that is pulling their money out. So a lot of that has to do with what is happening with the Federal Reserve and all the other major central banks. And part of that dynamic would tend to affect us simply because of the large offshore holding that we have in terms of the domestic fixed income market. And that brings me to the bottom slide there, where in the greater scheme of things, is Ghana really that bad in terms of how much offshore investors tend to own of the domestic markets? And what I've plotted for you there is you can see Ghana tends to play within the top quarter of broader emerging markets that usually fixed income investors tend to play in. And that is an important matrix for us to keep a hold of, simply because of if we see events in the global space starting to change, we can see some of that feeding through into our domestic FX market. So on a volatility basis, we tend to see that the rand, for example, is extremely volatile because there's a large offshore holding, and we're seeing some of that dynamic feed through into Ghana as well. So it's an important one to keep a hold of in terms of what the offshore investor base is doing insofar as their holding of domestic fixed income assets. So that leads me to what is happening from a Eurobond perspective, and I'm sure the papers here were littered in terms of what happened in the Eurobond roadshow that the ministers and the authorities recently came from, where there was a $3 billion Eurobond that was garnered from the offshore markets, and a large part of that is going to be used for maturing some of the shorter dated instruments. And what happened there, I think, is a function of several things. Number one, there are concerns around, what Ghana looks like, post IMF. And I think the sentiment, judging from some of the conversations that I've had with offshore investors, is that, there are some questions around whether we were going to see large fiscal indiscipline or whether we're going to continue to see this fiscal prudence that we've seen over the last couple of years. And the answer in terms of where the market is at the moment is somewhere in the middle. So we might see, some fiscal slippage. I mean, we are going to be entering an election period, but at the same time, there is a view that the lessons that have been learned under the IMF program will be carried through over the next few years, and that partly contributed to the large demand that we saw of these Eurobonds. At some point, there was the order book was 22 billion relative to the 3 billion that was ultimately issued. So there was huge appetite around that. But it's not all, for Ghana's credit. I think, like I mentioned earlier, there is some issues around what is happening from a global EM environment. And, with what the Fed has been saying in terms of some of its statements, has really played in the favor of frontier markets and emerging markets. And that played into some of the demands that we saw for the Ghana paper. And of course, we saw this was the first issuance out of Africa this year, so there was a real starvation of assets around Eurobonds. So this, really worked well in our favor. So I think the timing of that was particularly great in terms of ability to actually raise the amount of money they did at the price that they did. What I found particularly interesting is, as we went through, the final few hours of that particular issuance, normally you tend to see that, existing bonds tend to weaken simply because of the new supply that was coming through. But we saw the opposite in terms of what existing Ghana Eurobonds were doing leading up to the final issuance, and we saw that the price was actually appreciating, which shows that there was a huge appetite for Ghanaian paper. So I think there are some strong signs in terms of investors willing to give Ghana a second look in terms of, what the ministry is doing and what the fiscal policies are going to be going forward. So that should be quite positive for us sitting here with a view in terms of what's happening from a fixed income space. So I think the interplay between the local fixed income market and the Eurobond market gives us a very good sense in terms of how offshores are looking at the developments that are happening here locally and the ability to actually raise funding at different prices. So I think so far it's thumbs up, and we hope that over the next few months and over the next few years we'll continue to see that fiscal discipline that would obviously work well in terms of ability to actually raise funding, which ultimately feeds into debt servicing costs and everything else that goes with the macroeconomic view. So that is my 2-minute spiel. I'm not going to give you the 3-hour version. At this point, I will ask our MC to come and introduce the panel going forward. Thank you very much.
Thank you very much, Neville. And we're not going to dwell too much. Let's get the experts here and get their thoughts. Ladies and gentlemen, help me welcome the Minister for Information, Mr. Kojo Oppong-Nkrumah. And also Professor Peter Quarty from ISA to join the panel as well. I'd like to welcome. At this point, I'd like to point out that if you have questions, you can go online to Slido, slido.com, and enter Ghana First in the meeting column, and that should take you to a page where you can submit all your questions, and then we can fill them and pass them on to the panelists to answer. We're live on Joy 99.7 FM, also live on the JoyNews channel, which is broadcasting on the multi-TV platform, and also on DSTV channel 421 across Africa. And the hashtag to use is Ghana's Economy First. And also, for those of you who would like to tell the world where we are, we're also streaming live on myjoyonline.com, as well as on all platforms, YouTube, Facebook, and Periscope at First National Bank GH. So I'm going to dive straight into the questions. I'd like to start off with the Minister of Information, and this is not picking on you in any way at all, but I just would like to get your thoughts on whether there were any highlights from Neville and Celeste's presentation.
Yes, thank you. And good morning to Neville, Celeste, and to Prof, and to the audience here. No, I don't mind being picked on at all. But specifically, there were a number of things that I think come out quite strongly in the presentation. And the first is that this is more or less like a poll of polls, putting together what various other polls or various other reports say. And one of the things that comes home very strongly to me is that yes, Ghana is reforming, but others like Rwanda, Kenya, Nigeria are making more significant reforms than we are doing. Right. And what that says is that, for example, moving on, reforms must also be in very significant areas. If you look at the Nigerian detail, for example, the Forex issue is one issue that is very significant within the body of reforms. And when you tackle that alone, it kind of has a way of pushing you further than others. So in terms of our reforms moving forward, we have to tackle some of the very significant issues. And I think as time goes on, we will have the opportunity to hit on a few of those. Our reforms also have to be benchmarked with what others are doing, or benchmarked to what others are doing. Else you can be of the view that you are reforming, but others will outpace you, and you might come out, slipping from 5 to 9, and it may look like you haven't done much. And so you need to benchmark as well. On the north side of the presentation, which deals with the economic activity, I think what comes out to me strongly is that we have to stimulate higher, broad-based, resilient growth. I mean, what has worked for us in the recent years, which is now going to normalize, can do with some more broader base. Is mostly in the oil and gas area, but what it means is that we also have to broaden it and make it more resilient and regular, so that in terms of the economic activity space, as compared to other jurisdictions, we don't lag behind that much. For me, those are the first things that hit me, in addition to the other opportunities, etc., that are available.
Okay, so we have about 30 minutes, so I'm just going to do a quick round with each of you, and then we'll all jump in and have one big conversation. I'm coming back to you again, Kojo. So we've dropped from 5 to 9. What plans do you think, or what actions will be required to, one, hopefully stop us from slipping out of the top 10, but more importantly, drive us further up the ranking?
Thanks. So like I said, it's in two broad sides. There's the economic activity side, and then there's the reform space. In the reform space, we have to tackle, as I hinted earlier, some of the more significant issues. You can have a list of 9 reform items, but depending on where they fit on the pain point of the business community, if they are not that significant, you won't very far. One of the things that we need to very quickly deal with is the issue of trade facilitation and the difficulties that are associated with trade facilitation. It has a way of translating even into prices for products that are imported, etc. And currently, government has been heavily engaged on improving the trade facilitation framework so that it is easier for people who want to do business, particularly on the international markets in and out, to find space so to do. Another thing that we have to very strongly tackle in the reform area is access to financing. And you were talking about, credit growth, and even on the equity sides, the availability of a pool of funds to fuel business. Again, like you mentioned, because of the fiscal indiscipline in recent years, which is now coming home to roost, you will find that, for example, in the financial services sector, which is what gives access to credit, you've had a constriction of it. You've had to literally do a bailout in the financial services sector, and you are now getting the financial services sector a bit more resilient to get credit back on its feet. And so what we need to do is to quicken our efforts in the access to financing space so that the private person who is requiring financing to fuel his growth in that area also has room to go. Very quickly, we also have to get a thumb on these stability indicators like inflation, currency, interest rates, and I'm happy to see that your forecast suggests that we don't have any major red flags in that area, although we would have wished to maybe even get it down a bit further. We are using 4.80 for the budget in terms of the currency. You are looking at 5.20, but I think generally we're talking about the fact that stability must remain so that it's easier for business people to do business. I think 2 quick things that we are looking to do is to ensure that government incentives for strategic growth poles are heightened. The areas of interest, low-hanging fruits include infrastructure, like you mentioned, power, water, those areas. But the specific interventions that make it easier for the private sector to play in that space. If you're looking at about 3% of GDP from the government side into infrastructure, and the benchmark is 6%, the test here is what do you do to attract private capital to augment this 3% that you are putting in? So those government interventions for strategic growth poles, I think we have to be very quick at it. And finally, and tied to that, significant improvement in infrastructure, which supports business and other economic activity. These are, I think, about the 5 key areas that we are looking to focus on so that we can ace perhaps the next report that you put out.
Okay, thank you. I'm going to you, Professor Quartey. In 2018, quarter 4 to be precise, ISA did warn against excessive borrowing, and that's not the first time any such warning has gone to any government under the Fourth Republic. But borrowing is sometimes also quite justified. But clearly we haven't made the strides that we hope to make with the borrowing. So how do you see us sustainably continuing to borrow but grow?
Good morning, everyone, and thanks for inviting me. Debt itself is not a bad thing. It's not a bad thing to borrow, but how you use the money is what is very important. And to what extent are you able to finance the debt without causing much damage to your economy? Yes, we did warn against excessive borrowing, because if you look at the debt GDP ratios, it was in the 60s, where at a point hitting 70. I think at a point we had 73%. And if you look at the IMF assessments of, I reviewed the assessment reports of several countries, Ghana, Kenya, Cote d'Ivoire, and we were amongst the few that were red flagged. Looks like our debt levels were unsustainable, and we could see that having implications on how much revenue, how much expenditure in terms of we're able to make in terms of capital expenditure and in certain critical areas. So We needed to raise that red flag. As we continue to borrow, we are hurting certain parts of the economy, critical sectors of the economy, and I think we need to be wary of that. Then how efficient we use this money is very critical. It's not just borrowing for borrowing's sake, but to what extent are we able to track the funds and make sure that we get value for money in most of these expenditures? I think that's an area that we thought we needed to flag. One other thing we saw is that it's not just borrowing, but we were gradually having a lot of foreign denominated bonds, etc. And that has repercussions on your exchange rate. And I think the presenter mentioned our capital flight. The least noise or discontent, investors will move funds out. And that is one of the reasons why our exchange rate had this turbulence in that short period. So it is important to raise red flags against high debt or borrowing.
Okay. For those of you just tuning in to Joy 99.7, you're joining the 4th Economic Business Breakfast Forum, coming to you from the Movenpick Ambassador Hotel here in Accra. And on the panel is the Minister for Information, Mr. Kojo Nkrumah, and Director of the Economics Division at ISA, Professor Peter Quartey. Celeste Fauconnier is an analyst from RMB, as well as Mr. Neville, and I'm going to take my time, Mandimika is our making up the panel. And you can join us with your own questions by going to slido.com, slido.com, and enter the code Ghana First, and you'll be able to submit a question so we can try and get some answers for you. That said, Prof, inflation was highlighted in the conversation. A number of factors were considered that if we were able to mitigate would help us stabilize inflation, which has a knock-on effect on the currency. But how much attention should we pay to inflation? How can it make or break our stride towards economic growth?
Inflation is a necessary good. You need some level of inflation in your economy. So I don't think we should be so fixated on inflation that we want single-digit inflation, we want low inflation. Yes, some stable level of inflation is good. But I think going forward, and I think we've made this point, that we expect that as a country we should have an optimal level of inflation. We need to estimate that and know that this is the level of inflation that is not going to hurt jobs, that would ensure that, yes, you grow. Because there's a trade-off between inflation and employment. As government tries to cut down on spending, if you are not spending, you are not also helping to create jobs. So we need to strike a good balance between how much inflation you can contain to ensure that businesses are able to project and able to invest and make revenue. In the same way, you also have to have a cap on how much inflation you can contain. And I think there's been quite a few estimates. The IMF has some estimates that says anything in the range of, if my memory serves me right, between 15 to 18% for a developing country is acceptable. As a country, I think we need to estimate this optimal rate of inflation so that we know which figure we're actually working with. Okay. Thank you.
All right, just before we all join in and I start going to the questions coming via Slido, finally, there was a key point about what the investor community would be looking out for, which is track record from Celeste's presentation. So we have some new great ideas on paper. We're now implementing some of them. The world would want to see how well that goes, but we're in a hurry. So how do we build track record in a hurry? It's as though a job advertisement says, you know, we want someone who is 5 years experience, but the people who really want it have just come out of school. We need to bridge that gap. How can we do that quickly?
Yes, we're in a hurry, but there are certain basic fundamentals that we need to get right. So for me, getting the macroeconomy fundamentals stable is one of the key things that, and I believe government has been working quite well in achieving most of these macro targets. Nevertheless, there are quite a few things we need to do right. Access to credit is very critical for most businesses. The cost of credit itself is too high. If you have to borrow at 31%, 28%, what kind of business can you actually do and break even? I think that is quite critical. Okay. So we need to look at that. I'm quite excited. I was quite excited to see the index, how we compared with other countries in terms of infrastructure, in terms of all the key things, power and the rest. But I think it's not just the numbers. What about quality? I think, and that's a point I make to the editors of the report. If you're able to delve down into quality, we can have power. To what extent is it stable to ensure that businesses are able to use this to produce? I think that is very critical. But how can we move fast with this? One thing I find a bit lacking in our discourse is, what is government doing? What are government policies? And I can refer you to the 10-point industrialization strategy. I always say there's a lot of rich information in there. I believe we should tease out what is in there. How do we implement these strategies? If they are well implemented, in my view, if we are able to achieve 60 to 70% of what is in there, and I'm sure Ghana will be a better place to live.
I like the silver lining in there. Mr. Fauconnier, I know you want to add a rejoinder, but before then, Celeste, did you anticipate Ghana slipping from 5 to 9? Let's see.
It helps when it's on. Yes, we did, unfortunately, but it was for two reasons, and the minister has alluded perfectly to the one, to say that other countries have been reforming faster than Ghana. Countries like the smaller countries in East Africa, like Rwanda, to your bigger economies like in Ethiopia, have been moving up the ranks, specifically in its business environment rankings over the past few years. Rwanda being the fastest reformer, in fact, in the world when it comes to its business environment. So that's one of the reasons, but unfortunately the other reason is that fiscal indiscipline that we have seen, unfortunately, and that has brought sentiment down. Not just sentiment, it actually physically showed in some of the surveys that tax collection, higher debt levels, the effects that it had on ratings agencies' views and reports on Ghana in the past 3 years, which has thankfully improved, but that has impacted the surveys that we use into the inputs.
Okay. So, Neville, the presentation indicated that one of the areas that we'll have to focus on in terms of navigating the challenges would be that we focus on technology infrastructure. If we hazard a jump out of the box for a moment, technology and people is being touted as the next level of infrastructure. Can we start refocusing on that instead of the hard brick mortar and steel infrastructure that most of the countries in our grouping are focusing on?
Well, I think it's a combination of balancing the two, because you can't invest in your people, i.e. education, but you can't move the people from one part of the country to the other. So you need to take a two-pronged approach where you're obviously focusing on the transport, building bridges and everything else, but at the same time you're ensuring people mobility between countries. So in more developed countries, take South Korea for example, it's very easy to live in one part of the country and work in another part of the country.